inflation remains elevated, and says supply and demand imbalances, along with a variety of other factors, are causing it. Ukraine invasion, they say, is causing human and economic hardship. Implications of the invasion for the U.S. economy are, quote, highly uncertain. However, it is likely to create upward pressure on inflation. One more note here on the economy. They say indicators of the economy have begun to strengthen, and job gains have been strong. So good on those two scores. But I think you have to underscore that now the median Fed official does see the funds rate above the neutral rate for 2 years. Kelly?
A lot of huge developments here, and we're seeing some big moves already across the market. Steve, stay right there as we bring our panel back, along with Bob Pisani and Rick Santelli. Rick, can I start with you? Some immediate moves in the bond market here.
Well, I like to watch the yield curve. That gives you all the immediacy. The yield curve tends to twos. Right before the announcement, it was trading 31. Now it's trading 27. So what happened is we are seeing short maturities like 2-year and 3-year notes, even out to 5-year notes, much more responsive with the selling pushing rates higher than the long end. You know, we're coming close to 220 in a 10-year, which was at 218 prior. So that is the move there. And if you look at the dollar index, it's rallied just a bit. And, you know, it's in a zone of roughly a 2-year high. But to me, watching the markets, listening to Steve, it seems to me that we are all putting an awful lot of faith in the market's assessment on the fly of what 2022 is going to look like by year end with respect to the Fed. And I will continue to throw it out there that whether it was 2018 or other cycles, that these things can change very quickly. Just look at December of 2019 Fed funds, as the market at the end of 2018 had tightenings, then didn't want them anymore and just kicked them right back out.
Rick, thank you. Bob Pisani, your thoughts here on the markets, which we immediately saw the Dow come off its levels prior to the decision, but it's still hanging on to about a 150-point gain.
Yeah, it's pretty modest. We're down 7 or 8 points in the S&P 500. This is buy the rumors, sell the news. Powell is essentially not saying anything that people were not anticipating, playing up high degree of uncertainty, it looks like, in this statement. They're trying to maintain maximum flexibility. I think he'll leave open in the presser the possibility of more than 25 basis points. Some people might be a little bit disappointed that we're looking at 7 rate hikes. That's essentially one for every meeting in 2022. But I'll tell you how confusing this is, Kelly. Half the traders down here believe the Fed is going to make a policy mistake by not raising rates fast enough to combat inflation, and the other half believe the Fed are going to make a policy mistake by raising rates too fast, too aggressively, and will induce a recession. That's how confusing things are. And remember, when you're that confusing, you stay right in the middle. It's like chess. When you don't know what to do, just push the pawn. I think he's essentially just pushing the pawn right here, and this is pretty much in line with the expectation.
Let me turn back to our panel, John. If I may, I'll call you the most bearish, although I heard David Kelly not wanting to see a lot of these hikes either. So, John, what's your reaction as someone who's worried the economy is slowing to the fact that the Fed itself now expects to raise rates a quarter point every meeting 7 times for the rest of the year?
Yeah, I think that price in particular was already in the market. But I do think that the risks are there. You know, I think one thing that you just heard is the yield curve's flattening. You know, as bond investors, we take that seriously. And I think that's kind of the message there is clear, which is as the Fed's hiking interest rates, you know, the growth risks are there. And that's why people are buying, you know, preferring back-end bonds to front-end bonds. So, you know, I'm not sure that the 7 rate hikes is all that different than what the market's priced. But I do take the yield curve flattening seriously. And you know, the risks are there. I think at some point, by the way, I think the Fed's going to take that seriously as well. The Fed is not unaware of what the yield curve's doing. And so at some point, you know, if those growth risks materialize, that could change their tone. It could inject a note of caution. It could ultimately get them to slow down a little bit. We're not there today. That's not what's happening today. But that's certainly a possibility in the future.
That said, David Kelly, the Fed itself has acknowledged that the long end may be 1.5 points below normal because of quantitative easing and other factors. So they may or may not take the 2s, 10s as gospel here, even if it's